Before we start this video, do like and subscribe to our channel and not miss on any updates.
Friends, let's now move into the most important concept in this chapter, that is management of working capital itself. The scope of working capital management can be seen in broadly into two areas. The first one is liquidity and profitability, and the second one is investment and financing. Let's now talk firstly about liquidity and profitability. Friends, we have been saying that having sufficient funds or investment in working capital is very important for the smooth running of the business, so as to ensure that there are no stockouts, there is no pressure on the addressing of the current liabilities. Therefore, sufficient investment in current assets has to be made. At the same time, parallelly we said the investment in working capital should not be too high, because every rupee of the capital has a cost. Therefore, having unnecessary investment in working capital will also increase huge costs. Therefore, there has to be a trade-off between having the ideal or appropriate investment to be made in working capital, so that there is no hurdle for the operations of the business, and parallelly not too much of investment is made in the working capital. Now, this liquidity and profitability is a contrasting concept, wherein when you have more liquidity, you will see less profitability, and when you see more profitability, that means it is less liquid. Now, how does this happen? Let us first understand mathematically as to why is it actually conflicting or contrasting. Let's say liquidity versus profitability. Now, how do we indicate liquidity? Having more current assets. There is another ratio called current assets by fixed assets ratio, which also talks about liquidity. But for the time being, for easy understanding, let us express liquidity in the name of current assets out of total assets. What are total assets? Current assets and fixed assets. Now, why did we take total assets when we already have something called current assets by fixed assets ratio? We will come to it later. Let's see. Versus, how do we express profitability, friends? It is expressed as return on investment. Return is signified by the term EBIT, and investment is signified by the term the total assets, because the total investment is made in total assets only. Hence, current assets by total assets will talk about liquidity position, and EBIT by total assets will talk about the profitability position. This is just to understand mathematically why there is a contrasting result in terms of liquidity and profitability. That is, we say more liquid, less profit, less liquid, more profit. Now, when you say it is more liquid, that means I am increasing my current assets. Obviously, yes. Now, when I am increasing my current assets, what happens? Obviously, this ratio will increase. Current assets by total assets. Say, for example, initially my current assets by total assets is 1/2, wherein I can say 1 is current assets, 2 is total assets, out of which 1 is current assets. Therefore, 1 will be fixed assets, that is 1/1 plus 1. Now, if I gradually increase this, if I say if I want to make current assets 2, assuming fixed assets remain constant, this will be 2/2 plus 1, that is 3. Increase by 1 more lakh or 1 more thousand, whatever, 3/4. Therefore, this is 0.5, this is 0.666 and 67, this is 0.75. Therefore, if you gradually increase the current assets, obviously what happens? The liquidity position also increases. Now, come to the profitability aspect. Now, the more and more increase in current assets we said will result in the increase in total assets also. Now, when you come to profitability, when total assets increase, that means the denominator is increasing. When the denominator is increasing for the same level of profit, what happens? Obviously, profitability decreases. Vice versa. That is why we say liquidity and profitability are in contrast with each other. Having seen the mathematical relationship between liquidity and profitability, let us infer a conceptual point out of this conclusion. That is, if we say liquidity increases. Now, when liquidity increases, what happens? We said profitability decreases, but before that, if the firm is more liquid, can we say it is less risky? Obviously, yes. The risk of addressing the debts is very less, because it's got good amount of liquidity. I am talking about short term debts. Therefore, more liquid implies less risky. Liquidity is high implies risk is less. Now, we know liquidity is high means profitability is less. less profitability. Now, what is the relationship between risk and profitability? Less risky, less profitability. Is that fine? Definitely yes. We always say more tendency to accept risk, more can be the possibility of return. That is why we say there is a relationship between risk and return, no friends. That is, if you can take a higher risk, you can earn a higher return. If you are not ready to take a higher risk, if you want to take less risk, the return also expected should be less. Therefore, there is a linear relationship between risk and return, but there is an inverse relationship between liquidity and risk, or liquidity and profitability. Similarly, we can also write liquidity is less means high risky, also high profitability. This is the general understanding between liquidity, risk and profitability. Let us now move ahead to understand individually what will be the impact of having these current assets on a higher side and on a lower side. Let us write down the higher and lower sides and then show the impact of all the current assets individually. Effects of high and low investment in working capital. So, we will write about the particulars first. Then we will talk about having on a higher side and then on having on a lower side. Firstly, let us talk about inventory. Now, what happens when inventory is high? Definitely more capital is required. Therefore, we can say it is more liquid or less risky. But friends, though it is less risky, are we not blocking too much of funds here? Definitely yes. So, the good part is there will not be any stock out costs, there will not be any pressure or fear of stock out, but high amount of capital is blocked. So, let us write down those 2 points. More capital, less stock out risk. Now, what will be in case of low? Quite opposite, less capital and more risk towards stock out. Less capital requirement, but more stock out risk. Now, let us move to the next point, that is receivables. Now, the techniques what we use for the purpose of managing these two for inventory are, we said techniques like just in time technique, EOQ technique, etc. Then coming to receivables, this is about inventory. Coming to receivables, what happens if receivables are high? What does it indicate? Achha, so high investment in debtors, that is you are allowing higher credit sales. Therefore, there will be a possibility of attracting customers, high possibility of high sales. Definitely yes. More sales, but also more bad debts. That is, you go on increasing the debtors, there is a possibility of higher bad debts. Definitely yes. What about the less case? Same, quite opposite. Less attractive for sales, and you can quickly realize cash because the debtors are very less. Therefore, what happens? The realization of cash will be quick. Quick cash realization, because the focus is more on cash sales here. Then moving ahead, now what are the techniques generally we follow for debtors management? We take into account the credit policy, we take into account the discount policy, also like factoring. Factoring is a very important technique, friends. As we said earlier, we will look into this when we talk about receivables management chapter separately. Moving ahead, prepaid expenses. Now, what is the effect of making high prepaid expenses? You are avoiding uncertainty. You are making the payment now itself and avoiding uncertainty. That is one good part. There is another good part of making high prepaid expenses. That is, in case of inflationary conditions, that is, whatever material you wanted to purchase after say 4 months, if you purchase now and if the conditions, economic conditions are inflationary, then what happens? Achha, instead of paying high in the future, you are paying low now itself. Therefore, but the problem is blocking funds earlier. So, more blockage of funds, but advantageous in inflationary conditions. What happens in case of less investment in prepaid expenses? Same, quite opposite. So, less blockage of funds. The advantage, if you have to talk about, you can utilize it for an alternative purpose. So, utilization for alternative investments. This is about prepaid expenses. Then we will move about, so a cost benefit analysis has to be made before making a decision in respect to investment in prepaid expenses, a cost benefit analysis. Then moving ahead, cash. Friends, what happens if you have high amount of cash with you? Definitely the good part is you are more liquid, undoubtedly. You can address the obligations comfortably. There is no threat for the creditors or the current liability providers. So, what the good part here is? No threat for suppliers or creditors. You have good amount of cash to address and have run the day-to-day operations. So, what happens if you have less cash with you? Definitely there is a threat for creditors. But what is the advantage if you keep less cash with you? Just like the prepaid expenses, what we said, the funds can be utilized for alternative investment. So, utilization of funds for alternative investment. But friends, if you have good amount of cash and if you can address all the current liabilities quickly, will it not increase the goodwill of the company? Definitely yes. So, you have to mention that as increase in goodwill. Therefore, correspondingly there also we can say there is a threat for goodwill. Definitely yes, when cash is less, there is always a threat for goodwill. When the company does not make the payments in time, there is obviously a threat for goodwill. Now, moving ahead, we will lastly talk about also the payables. Now, techniques generally what we use here is cash budget. Then payables. What happens if payables are high? That is, you are not paying. Payables are high means you are not paying it currently. That means you have high amount of capital with you which can be utilized appropriately. Therefore, availability of high capital. Availability of high capital which can be utilized for investments. Now, what if payables are low? What is the advantage? Very simple. If payables are low, you can address them very comfortably. This again will result in having or creating a goodwill. Therefore, easily addressable financial obligations resulting in goodwill. Therefore, these are the effects of having high or low amount of investment to be made in working capital, that is current assets and current liabilities. Let us now move to the next segment in this management of working capital. We have seen about liquidity and profitability. Let us now move ahead and see about investment and financing. So friends, we have been mentioning that working capital policy is a decision of two major functions, that is, one, investment in working capital, and two, financing of working capital. Now, firstly, we said investment in working capital is to understand how much has to be invested in working capital. That is the primary job. Secondly, once we know and understand as to how much has to be invested, the second question comes in is from where do we generate the funds for the purpose of working capital. As we mentioned earlier, regarding the financing of working capital, we will see in the later part of the chapter or unit, but whereas coming to the investment in working capital, we said majorly it is the policy decision of the company to be taken which has or which is being influenced by some major factors like nature of the business, type of the product, type of the industry, then volume of sales and also credit policy. We mentioned a couple of times earlier also that nature of the business plays a very prominent role in estimating the working capital requirement. That is, if you are talking about an infrastructure company wherein there is a huge time lapse between the purchase of raw material and generation of cash out of sale of the product. That is, you bring the raw material today, you take the purchase cement today, you start constructing the flat apartment or even a residential complex, whatever, any infrastructure company. Then by the time you sell the product, it will be definitely more than 1 to 2 years. Therefore, there is a huge time lapse between purchase of raw material to the completion of the process operating cycle, that is sale of the product and realization of cash. Therefore, huge amount of working capital will be required for infrastructure companies. Vis-a-vis, we have seen a restaurant industry wherein today you purchase the raw material, by end of the day you generate sales. Therefore, nature of the industry plays a very prominent role in understanding the working capital or estimating the working capital requirement. The second type or the second factor could be type of the product. That is, if the products are consumer durables, definitely the working capital will be high because they have to be used for a longer time. The preparation also will take a longer time. Whereas for perishable goods like food, fuel and all, the time, the utilization time is very less. Therefore, they have to be sold very quickly and hence the realization of cash is very quick, and therefore the working capital requirement is also very less for perishable goods when compared to consumer durables. Moving ahead, the next we said is type of industry. What type of industry we are talking about, whether it is a manufacturing concern or whether it is a trading concern or if it is a service industry or service provider. That is, in the case of manufacturing concern, we said you have to get the raw material, it has to be sent to the store, it has to be worked on for the process which is called work in progress, then it has to become a finished good, then it will stay in the warehouse, after some time it will be sent for sale. Even when it is sent for sale, it will not realize immediately because it can be sold for a credit. Therefore, debtors are generated. Only when these debtors are realized into cash, then we will get the cash. Therefore, there is a long process in case of manufacturing concerns. But in trading industries or trading concerns, what happens? You buy, you keep it with you, you sell. Therefore, you save some amount of time. Also, if the sale happens instead of on credit directly for cash, you are still reducing the working capital requirement. You talk about service industries, there is no purchase of material, there is no sale of material or no sale of any finished good also. Therefore, depending upon the type of industry also, the investment in working capital increases or decreases. Moving ahead, we said volume of sales, that is high volume of sales also results in high amount of receivables. That is, friends, to attract customers, what companies generally do is they sell on credit. Therefore, if you are increasing your debtors, obviously means you are blocking your fund in debtors. Therefore, to the extent of such blockage of funds also, high amount of working capital will be required. Lastly, credit policy. That is, having a liberal credit policy does not only mean the company is increasing its receivables, it also means that the company requires more fund to purchase the raw material. Credit policy talks also from the creditor's point of view and the debtor's point of view. Therefore, these are the major 5 factors which will influence the investment in working capital. That is, firstly, nature of business, then type of product, then type of industry, then volume of sales, and lastly, credit policy. Friends, let's now look at the approaches in working capital investment. Majorly, there will be 3 types of approaches. The first one is aggressive approach, the second one is conservative approach, and lastly, moderate approach. Let us just pen down all these 3 approaches and then understand what are the characteristic features of these approaches and what are the effects, be it good or be it bad. So, approaches in working capital investment. Firstly, aggressive approach, then we will talk about conservative approach, because moderate approach is only an adjustment of these 2 approaches. Let us see first what is aggressive approach. Friends, in aggressive approach, less investment is made in current assets and the credit policies are strict and cash balances are maintained less. So, the features are less investment in current assets, strict credit policies, then low cash balances. Friends, as a result of these characteristic features, what happens in case of aggressive approach? Let us understand. Firstly, less investment in current assets. What is the good part of investing less? More capital is available, unutilized. Instead of blocking too much funds here, more capital is available for alternative investments. Most important point is, as the capital is less, the cost associated with the capital is less. Therefore, the good point here is low cost. Low cost, therefore, more profitable. Low cost and more profitable. This is because of low fund blockage. The reason is low fund blockage resulting in low cost and more profitable. But friends, tell me, if the current assets are not sufficient to address, is there not a threat of liquidity? Definitely yes. There is a threat for liquidity. There is a threat for goodwill of the company. Let's write that point also now. Threat for liquidity, threat for goodwill. Therefore, even though the approach is aggressive just because it involves less cost and because of less blockage of funds, please do not conclude that is a very good approach, because it involves also some bad effects. That is, there is a threat for liquidity and there is a threat for goodwill of the company. Let us now move to the conservative approach, which is a little opposite to this approach. That is, more investment in current assets, then liberal credit policies, and lastly, high cash balance. Therefore, if you remember one approach, the other approach is just opposite to the first one. Then, what are the effects of these high investment in current assets? Let's talk about the bad first, or because we have written here for the aggressive approach, we have written the good points here. Let's write the opposite of that, that is the bad points, and then we will conclude with the good points, so that the correlation will be a little easier. Now, low fund blockage, here we have high fund blockage, high fund blocked. Then low cost, high fund blocked, therefore high cost. High cost obviously means less profitable, less profitable. Now, these are the bad points. Coming to the good points, is there any threat for liquidity, friends? Absolutely no. Therefore, sufficient liquidity. Now, because you are investing a higher amount of, making higher amount of investment in current assets, what happens is definitely you will increase also the sales. Your credit policies are liberal, your investments are more in current assets. It is not just liquid, it also results in higher amount of sales. Attractive or attracts higher sales, increases. We have good amount of cash balances, therefore it increases goodwill. The last 3 points we can relate very well to the first 3 points, that is more investment in current assets, therefore sufficient liquidity. Liberal credit policies attracts higher sales. High cash balance increases goodwill. So, this is how we understand the characteristic features and the advantages and disadvantages of aggressive and conservative approach. If you want to see even more conceptually as to how the investments are made in aggressive and conservative approach, let us go further. That is, friends, in the case of aggressive approach, we said more of funding is done, less of investment is made in current assets, and that too is made from the current liabilities. That is, if you look at the balance sheet in a horizontal format, we said long-term funds and short-term funds. Nothing but current liabilities. So long-term assets and current assets. Therefore, in aggressive approach, what happens is long-term funds generally fund long-term assets, short-term funds generally fund short-term assets. Here, there is a possibility that only short-term funds will fund the current assets. But if you look at the conservative approach, what happens there? Long-term funds, long-term assets or fixed assets, short-term funds, current assets. Here, majority of the long-term funding is done for the long-term assets. Also, a part of the funding is done for current assets. Therefore, only a part is funded by current liability. So, this is about conservative approach, this is about aggressive approach, wherein the current liabilities itself will be meant or supported, will be supporting the current assets, whereas in case of conservative approach, even the long-term funds will be supporting the current assets. So, this is about conservative and aggressive approaches. Now, there is another approach called moderate approach. Now, lastly, there is another approach called a moderate approach. Now, as the very name says, it is neither conservative nor aggressive. That is, you are neither investing too much in the current assets nor investing too less in the current assets. Therefore, by making a balance between the risk and return, the liquidity and profitability scenario, so by investing in such a moderate way, by making a trade-off between the risk and return, that is to ensure that the business operations run comfortably, at the same time the profitability is not impacted by blocking too much of funds and incurring too much of cost. Such an approach wherein there is a balance maintained is called as moderate approach. So, these are the three major approaches in investment in working capital, that is aggressive approach, conservative approach and moderate approach.